Here's some investing keys. How do you really make money when you are dealing with stocks? You cannot make any money in stocks until you sell your stock and make a profit, obviously. But the key thing to remember beyond the profit is that there will always be fees and taxes that are due, and neither are due until you sell the stock. Once the fees and taxes are calculated and allocated, this is when you get the pure profit. This is the amount you get to keep out of your whole trade, which is also known as residual income. The main thing is you can have any type of fees, whether they're commission fees from your brokerage or any management fee for anyone who manages your wealth plan or your investments. That's where these fees are allocated. Taxes, obviously, that's Uncle Sam. Anytime you make a profit on stocks, you're basically going to be issuing them a percentage of that depending on the timeline of your investment. So the longer you're in it, the less taxes you pay. The sooner you get rid of it, the higher tax you pay. And that's known as capital gains tax. This is what gets you your net return. So this is the allocation of your profits subtracted by expenses and taxes and fees. Now, most people think net return is the finality of calculating your profits and essentially your overall income. But there are two higher levels of analysis that have to be taken place to really understand how much wealth you're gaining based on what's happening in the entire economy and your opportunities. This is when you account for the rising cost of goods. This is called the real rate of return. Essentially, you're looking at inflation costs and cost increases of things that you purchase on the daily. So it's a much bigger analysis rather than just your business analytics. It's also what's happening in the entire economy, whether it's car prices going up, grocery prices going up, tariffs being allocated. The final calculation comes with your economic profit. This is analyzing your opportunity costs. What if you would have allocated your investment into another opportunity that you knew about, that was around your edge, that was within your capacity of analyzing, whether it's in the same industry, same sector, and doing an analysis in comparison of both. So where you put your money compared to where you could have put your money, subtract that, and that's your opportunity cost that you either lost or gained based on the investment you made. So the cumulative of all this analysis is how you really determine how much your wealth is growing. You can't just do the one, because then you'll be losing at some other angle and not knowing the percentages of what your actual profit is that stays in your pocket and stays in your accounts that are compounding. The other final thing is accounting profits are different from actual cash profits. Your accounting data can show in the balance sheet, hey, this is how much cash is allocated, but depending on how your bills are rolling in, the schedule of it, you might not have that sitting in the bank as a cash profit. So that's why these analyses are so important. It allows you to not only plan your future, it also gives you the set targets in the big picture of the big goals. Hey, this is what I need to be doing to get to this. This is how much cash I need to keep in the bank. This is how much debt I need to pay off. And these are my expenses that every month I need to pay. And then there's money I need to keep in my reserves for when I need to be liquid. So all these factors are narrowed down with this analysis of your returns. So make sure you're not keeping all that cash and spending it. Allocate everything early on into different accounts, whether it's your account that you pay your taxes with, your bills with, whether you understand, hey, inflation is coming, so I need to take this amount of cash and reallocate it somewhere else. So at the end of the day, you're just taking things in and plugging in different investments to basically come up on top. And the best analysis, the final analysis usually is comparing it to the S&P 500. So you want to average out more than 15% annually. That's going to take time. It's not going to happen overnight if you're making consistent long-term investments. You have to do a comparison on the S&P 500 because you might just be better off putting your money in the S&P 500 rather than investing in plays that is losing money in comparison to someone who's just blindly passively investing into the S&P 500. Here are 3 investing experts and leaders that you must get to know. First, we have Jeremy Siegel. Second, we have Asmat Damodaran. Third, we have Muhammad Al-Arian. These guys are all legends in the game. All three of these guys are professors, but Mohammed El-Erian and Jeremy Siegel are certified, well-renowned economists. These guys are highly demanded when it comes to anything related to macro and micro conditions, economic shifts, crisis. And not only do they know about the actual economic conditions, they're experts when it comes to investing also, because they've had careers in both paths. So they lean between a business economist and a traditional economist. And their knowledge has helped wealth funds, governments, the IMF, Harvard University, like Mohammed El-Erian, or with Jeremy Siegel at Wharton. Their resumes are incomparable. They're legends in the game. And then Aswat Damodaran, he's in NYU as a finance professor, and he's known as the Dean of Valuation. So he focuses on long-term investing and investing based on value. Basically the path Warren Buffett and Charlie Munger always advise. So following in this path is really good for steady growth and your retirement. He focuses on value, establishes a great way to get in on an investment and getting out with substantial profits. Even though Mohammed El-Erian is a traditional economist, his experience working at PIMCO and managing the Harvard endowment is what establishes him as an investor and somebody who can manage funds and wealth. And he speaks greatly about investing and risk. He's always talking about the balance between the two and limiting your risk being one of the key drivers of building your wealth. So a famous quote that he spoke on is when he advises investing only in what you know and with limited spare tires for markets. He's essentially emphasizing questioning both growth potential and error affordability, which is once again mitigating your risk based on the growth you're doing. Because at the end of the day, if you're checking up on the risk, you know when to exit, you know how the conditions are going to prevail, whether you need to stick with it in the long run or get out quickly, depending on how harsh the punishment is coming. His other quote that he's famous for is basically a phrase that he created, which is a bumpy journey to a new destination and the new normal. On the economic environment, with a new global order shift and emerging markets becoming more prominent as growth drivers, this is what he's talking about. Even though we're on the same journey, the direction of that journey might change, and the new normal is what is being established while we're on the journey. So the path is the same of analysis, the path is the same of the economic games played between investors and buyers and sellers, but the way the new normal is established is based on the economic environment and shifts in the macro conditions, whether it's emerging markets coming back into the picture or developing markets taking a step back. And here are 3 books from Mohammed El-Erian that you have to read. His knowledge is so exceptional. I read all 3 of these books. So the first book is When Markets Collide, Investment Strategies for the Age of Global Economic Change. The second book is The Only Game in Town, Central Banks, Instability, and Recovering from Another Collapse. The third book is Permacrisis, A Plan to Fix the Fractured World. Now, all 3 of these books will not lead you wrong. They've helped me in so many different ways, whether it's learning about the macro, the micro, how to protect yourself from taking risks, how to alleviate yourself from mistakes that you make. I mean, the wealth of knowledge that is in this book, I feel like every person should read this, even if they're not investing, to just understand the world a little bit better. Really happy, or you're a combination of happy, shocked, surprised, and scared. Because the way this market is moving, there's no telling. Economic data is saying something else. The war news is saying something else. The Mag 7 making a return is surprising. The software stocks that were struggling due to cybersecurity releases just made a comeback. Mining facilities are getting approved left and right for North America because they want to get away from China. So the market is essentially in a slight boom. But the legend Tom Lee came out and just said, even though we're going to see this great boom here for the next few months, expect a 20% drawdown at some point, which I can see that happening easily once people kind of get away from everything, start focusing on the fundamentals and also the Fed. So the combination of the two is what's going to kind of possibly bring that 20% drawback. But essentially looking at the earnings week, they're establishing themselves really well because all these companies are maneuvering around AI in a way where they're raising their profits, they're raising their productivity. Once again, it's also on the back burner of firing a lot of people. So how can you really say, it's going to be great for the economy? The S&P 500 is up 1.5%, hitting a record close of 7,259.22 cents on Thursday. Nasdaq Composite is up 1.8%, led by a 16.5% surge in AMD and 13% in Intel. Dow Jones is up 0.2%, lagged slightly, saw a brief dip midweek before stabilizing, but it's up. Russell 2000 was the winner. It's up 1.1%, benefiting from the broader risk on sentiment. Gold is up 3.2%. It broke above 4,700 an ounce due to a weakening U.S. dollar. Crude oil is down 6.8%. It slumped down to 95 BBL on U.S.-Iran peace deal hopes. So overall, the market is looking really, really good from where we were at, and the sentiments of the war distracting us on a daily basis. Approximately 89% of the S&P 500 companies have reported their earnings, and it's been great so far. It's looking like it's an everything rally, which has been amazing because gold is up, even Russell 2000 is up, where all the big names that were lagging and people were kind of backtracking away from are showing immense growth. And this isn't simply based on, buy the dip mentality. The earnings and the reporting and the growth projections were all great. So looking at the entire market, the only issue that's left is the concentration into semis, essentially the memory stocks and data center stocks and anything correlated with that. It does look like there might be a bubble forming with all this inflation in the stock prices, but we don't know when that bubble is going to pop. And the best way to get out of such bubbles is when you see it slowly trickling down. You don't want to get out trying to wait for the top or the bottom. You want to slowly ease your way out if you're feeling like the bubble is going to pop and there's just too much concentration in the market. We did get the University of Michigan service, which have been a little bit of a mixed report. So essentially, consumer sentiment for May was 48.2, lower than the street's expectation of 49.7. And lower than what we saw last month at 49.8. This was the lowest point that we have seen on record for this report. Consumers' expectation report came in better than the street's expectation at 4.85. Streets was looking for 4.81, and that was actually matching last month's print as well. 1 year inflationary expectations came in at 4.5%, previously at 4.7%. Current conditions came in at 47.8. Street was looking for 52. The last print was 52.5, so there's more contraction on this one also. And you can't blame anyone for it. It's solely because of policy decisions, both local and geopolitical, by the Trump administration that's really holding this one down. The non-farm payrolls came up at 115,000. We were looking for 65,000, which is a big gap. And we actually saw a positive revision to the upside for last month's print, going from 178,000 to 185,000. Manufacturing payrolls, we saw a reduction in jobs by 2,000. Private payrolls, which have actually increased by 123,000 for the month of April for 75,000. Once again, another positive revision for last month's print, going from 185,000 to 190,000. Jobs are up mainly from enterprise spending and a lot of metals and minerals manufacturing, and the healthcare sector is giving it an immense boost. There are some other sectors that have seen a slight jump, but overall it's been decent for jobs, and all the revisions are only showing upside. The caution is, when will families actually stop spending the amount of money they have been spending due to high gas prices, high utility prices, high grocery prices, and inflation just in general being sticky while the Fed can't cut? That confidence is kind of still very, very shaky. The wage component is really important here to understanding in relation to the job and what's happening in the macro, which is also a measure of inflation. Actually a little bit unique given the fact that we are seeing higher price wages right now are not really moving with those higher prices. You're actually seeing that decelerate here. 0.2% for average hourly earnings month over month basis. Street was looking at 0.3, and if you're looking at the year over year comp, that came in at 3.6%. Looking at the street, 3.8%. The previous point was 3.4%, and that was actually revised lower from 3.5%. You're not getting that wage inflation, yet usually also wage inflation kind of coincides with service inflation. We are seeing a good portion of inflation hitting the market, not so much services. Usually it takes some time for the energy markets to kind of have its impact when it comes to broader economy also. So right now we're seeing gas prices go up, but a lot of the other parts of the economy that are related to these oil prices and the cost of shipping and anything with transportation going up, those haven't hit us yet. So we need to still be patient and try not to, alleviate ourselves of this mental capacity of knowing that there's something coming. Even though everything from the data that we've seen in the short term is looking good, it doesn't seem like it'll last long enough as long as this war is going on and there's more disruption in the supply chain. Markets are holding up well with even all these issues that are going around. And one thing that could kind of explain that is the wage separation and how the 1% is living, how the middle class is living, and how the lower class is living. So at this point, real income has turned negative, which is terrible for the general economy, terrible for the general citizen. Yeah, we're seeing stock market booms, we're seeing enterprise booms, we're seeing capex booms. And I keep saying this, but people need to grasp once again the separation between the economy and stock market and why geopolitical decisions are tied to what happens here. We can't keep thinking, oh, that's happening over there in the Middle East, it's not going to affect us. It will, and it always does. So this wage gap is nothing we should be comfortable about, even with all the good reports and all the good stock market returns. We need to substantially study this difference and try to narrow it down, even though throughout all of humanity's history, we know there's been the have-beens and have-nots. But at this point, with this much technology, this much connectivity, that should be narrowing down and coming closer and leveling off. We should all be living better lives. So we've all heard of the acronym TACO, Trump Always Chickens Out, which started off with Trump's behavior around the tariffs and his cabinet not having an actual understanding of how tariffs work and making no legit sense of that whole process and going back and forth with different countries whenever he felt like it. So now we have the acronym NACHO, which is not a chance Hormuz opens. And once again, based on Trump and his cabinet's backtracking on everything they say, this makes complete sense because we're just stuck. Essentially, the order of how all this happened is we will win is what Trump said and his cabinet said. Then it became we won. Then it became we're winning. Then it became send help. Please help the Strait of Hormuz. Then it became I'll end your whole civilization. And then it went to we don't like the Pope and what he's talking about. And then it finally ended with Project Freedom, which we're stuck at now, which Project Freedom was essentially Trump saying that they're going to be helping out any ship that is stuck in the Strait of Hormuz and letting them find a safe way out. And essentially calling it Project Freedom because they're giving freedom to these oil liners that are stuck in there because of the U.S. So once again, it makes no sense. It has no logic. It's just a pitch to the MAGA followers who are a cult, who love to follow Trump regardless of what he says and regardless of all the lies he's already told to get into office. I mean, one thing Trump has done with his tariff issues and the war against Iran, he has kind of allowed U.S. citizens to realize how globally tied we are and how we can't just separate ourselves from the rest of the world. Now, looking at our trade deficit, the U.S. trade deficit widened in March 2026, reaching $60.3 billion, an increase of approximately $2.5 billion. That's 4.4% from the revised February figure of $57.8 billion. The expansion was primarily driven by surge in imports that outpaced a solid gain in exports, reflecting resilient domestic demand for foreign goods despite global shifts and the narrative the Republicans want to promote. This is showing the high consumption capacity the United States citizens have and the urge to buy foreign imports as much as they can and freely as possible, be part of the free market. The spending is heavily on the tech and transport sector, outstripping the gains U.S. is making in energy and service exports. So essentially, it's balancing us out. even though it's showcasing the mindset of the American citizens is still on globalization. We need these imports as much as we want to export. Essentially, we make the most money in the world as far as consumers go. We spend the most money as far as consumers go. So cutting that tie off from the rest of the world never made sense, and this has proven it further. The general population that do not do business or aren't entrepreneurs, they're slightly confused about how business works. It just doesn't go up and down. There's a period where business can just go sideways. And when you're that stagnant, it's actually much more stressful and much more demeaning to what you want to do with your business. If you're going up and down, then you know at least there's motions and activity that you can fix and solve. But when you're stagnant, it's more of a macro reasoning and something that's outside of your power to shift. So understanding that businesses just don't go up and down, they can stay sideways, is very important for the average citizen. Nobody is done buying U.S. equities. Nobody is done buying U.S. debt. We are seeing the dollar coming down and gold values going up. But as far as a nation goes, we're some of the most technologically advanced and educated people in the world. We have great institutions that are obviously being threatened by Trump and his cabinet, but we can fight through this. They won't be in office forever. They're going to try to fight. They're going to try to come and play. But it is our job and duty as U.S. citizens to maintain our institutions so we can stay ahead of the world as far as policies go, as far as equality goes, as far as checks and balances go. This is a fortitude of the United States, and we can't just let it go. This is the entrepreneurial spirit. And yes, with that spirit, we will diversify. We will invest in emerging nations. We will invest in other developing nations. But everything starts from here, because establishment of institutions, establishment of the level of education the U.S. has provided for centuries, that just can't disappear. We just have to revive it and enhance it and reestablish it. Once we do that, the U.S. is still going to be a top contender in the global markets, in the global supply chains, and in the global world order.